Hey, ladies and gentlemen, if you were ever looking for a mortgage loan, you got so many options out there. So many. So which one to choose from? You might have heard of things like, a retail mortgage type of situation, or maybe it's a mortgage broker that you might be going to get your home loan. So which one is best? Which one is going to give you, the best interest rates or lowest closing costs or whatever? Well, we're about to get into that in just a moment. But before we do, let's go on the table for some introductions. I'm Rob Kyleman.
I'm Joshua Britt.
All right, real estate agents, investors, and co-hosts of the Real Estate Talk podcast. Also joining us today is Phillip Ferguson from Nexa Mortgage. How you doing today, Phillip?
Doing great. Thanks for having me on.
Awesome. And we got Jeremy Berrios, branch manager of Movement Mortgage. Thanks for coming on the podcast, guys.
Thanks for having me.
All right. Joshua, what do we got for these guys today?
All right. So look, when most people look at their loan officers, right, they're like, hey, this person is holding the keys to my brand new home in their hand, right? Mm-hmm. They decide whether or not I get a loan. And, most people think that there's things going on behind the curtain that they don't know about, that if they knew about, they could make this decision a little bit better. So we'll start with Jeremy. Can you tell us the time, when was the most, because people don't see, the satisfaction that we in the industry, real estate agents too, get from helping someone accomplish their goal of buying a home. So what was the most satisfying time that you can remember of helping somebody buy a home? What was that story like?
Man, humbly speaking, I get those a lot because I do a lot of loan rescues. I'm really known as a loan rescue loan officer out here, but one recently, just because it's the most recent one. So this is probably going to stay in my top 5. Single mother, Hispanic from Puerto Rico, like myself. Also a Navy veteran. So again, something that really kind of really spoke to me. Her loan was denied, no pun intended, by a broker who brokered her loan off to one of their wholesale lenders. So meaning they took their application, the guy loan officer took it, and he shopped that person's loan around. Ended up getting denied. Communication wasn't that great, and we can get into that later. But essentially, 2 days before closing, said, hey, this loan isn't going to go through. Denial letter was sent, all that stuff like that. So she was left scrambling, didn't know what was going on. We were able to take her loan application, figure everything out, get it restructured, got her loan documents in, got her approved within 24 hours, and we close tomorrow. So I am very, very excited about that. Just to see that, people, when you're going to contract to buy a home, you're usually renting, and you give your notice to that landlord or to the apartment complex, and you got to be out. You've given your 60 notice, you give me your 30-day notice. She has no family here, has no friends here, where she could have her stuff, to get put, and her boys, need to be, the single mother. Like I had that same upbringing. My mother was a single mother, so I get what it's like to be a single parent household raising 3 kids, and her boys, from elementary on to high school, they need to keep living, right? And she needed to be in the specific area to stay in the specific school, so that life balance maintains the same way. And so it was just, really resetting expectations and really explaining to her, the why. And I'm really big behind the why, right? Like if you punish a kid or tell them to go to their room and you don't tell them why, they're just going to get pissed. If you go to the gym and you're just telling somebody to, do 12 squats, do 15 leg extensions, but you don't explain to them how or why, it doesn't really do you any good, right? So in this situation, really breaking down the entire process and explain to them, hey, this is why we are going to get a 2-year work history. This is why we're going to get a 2-year residential history. This is why we're going to get a 2-year income history, right? Like my job is to be an attorney and represent you, just like any good attorney would do in a court of law, right? Whether it's a civil litigation or criminal attorney, like they got to win that case for you. So my job is to get these underwriters, right? Because I don't care if you're wholesale or retail, you have to make the underwriters happy, right? You have to know your guidelines. These underwriters were hired to prevent another 2008 collapse. They're going to make sure you meet government guidelines, right? And your job is to build the case, right? And so you really get that buy-in from them, right? And you say, hey, look, I need these W-2s, I need these LESs, these pay stubs, these bank statements, these IDs. This is the reason why, right? And we're going to explain certain situations and we're going to maneuver things around. And that felt really good because, from a wholesale's perspective, they have options, right? They preach they have that many options. They have a lot of outlets for those loans, but it was a tougher VA loan. Manual underwrite, meaning there was no automated approval when you get a loan and we take your information. An automated underwriting system tells us if you can get an automated approval or not, and if you put accurate information in, then you're gonna be good to go. But in this case, we weren't even getting an automated approval. It was a manual underwrite, multiple late payments, certain things like that would typically prevent you, right? But it's understanding the VA guidelines and the VA circular. And, being a direct mortgage lender, we underwrite directly to what VA says because we sell directly to Fannie, Freddie, and the VA. So Fannie Mae, Freddie Mac, for people who don't understand what that terminology is. So that was so that one because it was most recently, and it she down to her last dollar, where she used her tax refund for her closing costs. Unfortunately, again, not all brokers, but this broker did charge her some unnecessary fees, charged her more for the appraisal than than he needed it to, and was kind of hiding behind another platform, and just really did wrong by her. So this one feels good to know that she'll be closing, and we had a small part to play in her journey, closing on her home. So this one because it's most recent, it feels good.
Nice. I'm glad to hear that story, and I'm glad it's being shared here because there are a lot of people out there who get denied for a loan for one reason or another. And it was good that someone said, hey, let me check with somebody else to see if somebody else can get this loan done. Yep. Because I think there are a lot of people out there who get denied loans only to find out that if you go somewhere else, they could get into a loan. And it could be for a number of different issues. And even more recently, we've seen the situation happen with Navy Federal, and where there was a lot of people who were getting denied loans through Navy Federal. And coincidentally, it was a large majority of them who were minorities.
Blacks and Hispanics.
Yep. And so, therefore, I think a lot of that came to light because people kept questioning, like, well, why are these people, these good people? Because to be, most of the people at Navy Federal is a credit union. You served in the military or your family of military.
Yep.
And so why are these people continuously getting denied loans? And I just think that with a lot of people going and seeking second and third opinions and getting loans, it eventually led for this story to be broken about how many people were getting denied these loans.
They have to. It's one thing where they're going to give you enough rope, and the government, to hang yourself, right? When they fill an application online, right, they're putting in what their demographic is, right? And they have to do quarterly and audit reporting on HMDA reporting. Okay, so they're saying, okay, you guys are funding this many transactions. These many transactions belong to white, Caucasian people, but these many people were Black, African American, and Latino, Asian, whatever, right? And majority of all of their denieds were Black and people of color, Black and brown people, right? So they were saying, wait a minute, these people have just the same as good credit, just as good debt to income ratios, just as good enough assets, but you're denying them. And matter of fact, to make things worse, what happened with Navy Federal specifically was they were approving loans that were much riskier for Caucasian people with higher ratio, lower assets, lower FICO scores, instead of the well-qualified Black and Hispanic person. Like that's a
I didn't even hear that.
You got to read the whole lawsuit.
I think we'll probably do another podcast on that one.
Yeah, we might have to bring you back on that one.
So yes,
you sound like you got a lot of insider information on that one.
Yeah. What about you, Phillip? I mean, have you a similar story?
Yeah, actually very similar. And I like one of the things that Jeremy said. And again, it really does depend on the loan officer. Because again, you can have bad loan officers at good companies that can really turn a file sideways.
Agree, Phil.
I'm one of the loan officers. I look at everything, just like Jeremy does. We're going to look at everything, 2 years of everything, just to see if there's anything that we're missing that another loan officer is missing. Now, equally, not all brokers are equal.
Okay.
We have access to over 250 lenders. We have the most access to most lenders at all at Nexa Mortgage. We have access to lenders who are also direct as well. So they have no overlays that they pass it on to us. So that's the good thing, is making sure your broker does have access. Obviously, your customer's not going to know to do that. But my most recent client was referred to me by retail correspondent lenders, got denied by 3 different lenders. Came over to me, got them approved. And the only reason is because, again, as a broker, traditionally we do have access to more riskier loans.
Subprime. Would that be more accurate?
Technically, yes.
Okay.
Yeah. I mean,
What is subprime?
Yeah, because there's a lot of people that don't know that. So, like, if we hear some words, we'll pause on them because people want to know what is subprime.
So,
Like,
so there's two. You could say, in one hand, they're the people who are technically below a 580 FICO score. Okay.
Okay.
There's, in another hand, you could say these were the same clients and the brokers that were responsible for the 2008 mortgage crisis. So.
okay.
They go hand in hand. So again, not every broker. So and we can kind of get into that history of it, whatever like that. But from 99 to about 2008, wholesale was the largest channel responsible for originations in the U.S., right? 2008 happened. Brokers were getting really wild with comp. We can get into that later. But, you know, now it's been more so, you know, balanced out in between retail and wholesale. But I'm going to let Phil finish that.
Yeah.
No,
Go
but
ahead.
briefly about that. Again, brokers weren't the only contribution to the 2008.
No.
Wachovia,
But Wachovia,
Which is a bank?
which is a bank.
which is a
Was
bank,
a bank, right?
Was a bank.
Yeah, was
no
a
longer
bank.
around.
Wells bought them.
They hired a ton of car salesmen to do the pick-a-pay loans. And again, they weren't brokers; they were bankers. But again, brokers are licensed, bankers aren't. So I mean, that's one of the things we used to say all the time is like, do you really want to trust your business to somebody who's not licensed? 'Cause
Everybody was doing ninja loans, no job, no income verification.
Right. And it depends on how you sold it. Because like what I did, I only did it for investors or person that was commissioned. Like I say, on your good months, yeah, double up. But if you have a really bad month, it's great to have that lower option and do the less than interest only option. But again, when you have a good commission month, then double up on your payments. So just again, even at that time, there's no such thing as a bad loan product. It's how you use it. You turn a hammer around the wrong way, you're gonna hurt yourself.
Yeah.
So I tell you, there's no such thing. It was designed for people who had commission income, fluctuating income, and that's what it should have been used for. Not
What,
for
the negative amortization ones?
Yes, don't let it go negative. But if you have a bad month, like it would have been good that you had it less interest on. But I told my clients, when you have a good month, you need to catch back up.
That's a philosophy thing. I would say, kind of like football, West Coast offense versus traditional pro style offense. I guess, I still think, a negative amortization, because how many of those people actually got out of a negative amortization mortgage?
But it's because the loan officer didn't educate them though.
Right. They're all, again, taking out Monday, loans closed Tuesday. Back in those days.
Exactly. And
So
that's the thing. It's just
no, they really no BS. That's really what happened.
Yeah.
Yeah. App Monday, you're closing your CTC on Tuesday.
Wow.
there's some other things that led to that too, though.
Yeah, but bankers, like you brought up Wachovia, one of their undoing was they tried to branch out too quickly out west, and they took on a lot of bad debt from another mortgage company who was just heavily into subprime, right? It was playing hot potato with these subprime and then like these fake, paying these bankers off, these insurance companies, the Moody's, AAA rated bonds, B bonds, but you take it all apart and they were just dog shit loans. If anybody out here who has, I think the dumbest way to really understand all that subprime stuff is if you haven't watched The Big Short.
Oh, yeah.
With
that
Steve
movie.
Carell.
Love that one.
I think if you haven't watched that, you watch that over and over again until you understand what really happened. If you weren't around or if you were too young to remember what that was, like that is legit what happened. So synthetic, CDOs and all stuff like that. Collateralized debt obligations, all that stuff. Is really what paid. That's why we have AMCs now for appraisers too, who are getting paid off, all that independent stuff. But yeah. All right.
Wow. All right, but Phillip, we didn't hear your story though. Like, tell us your story though about how you changed this person's life. I think they got disapproved at 3 different loans.
Yeah, 3 different lenders, and again, the realtor had a in-house lender that they referred to from this certain company. Couldn't get it approved.
Which company? No, just kidding.
No, but I mean, again, and it was a pretty big lender, and again, but the loan officer again is a top producing loan officer at a certain company, and again, once you get to a certain production, sometimes your customer service and your level of detail is not where it used to be. So again, it happens to even the biggest producers. But again, I was able to look at this file, get it done. Again, mine wasn't technically subprime. It was above 580, but below 620. Most lenders don't do down payment assistance under that. I can go down to a 580 and still get you down payment assistance. So I was able to put this client on this program, which no other lender can do. And that's the beauty, is that I have access to more loan products that I can do. I can do commercial, hard money, private money. So that's the great thing, is just, but again, you can still have a loan officer at a broker mess that loan up if they don't know what they're doing. So again, I was able to save the deal. And it's, again, another single mother situation, 2 handicapped kids. And it was saddened because, again, my brother was handicapped as well, so I felt for them. They wanted to work 40 hours. The one brother, if you work over 40 hours and make over so much money, they actually cut your disability income. And again, we won't get into it, but I think there should be some different methods for handling that. But again, you know, this recently divorced, and just she needed to be in a house because of the nasty divorce. Unfortunately, she had some late from the ex-husband that was on her credit report. Divorce decree says he's responsible for it. Wrote up a letter of explanation. And again, we got her approved for down payment assistance. Nobody thought we were going to get it done. Got it done. Lady super excited. And it was just great feeling to help them, because again, a similar situation with my brother being handicapped, not able to get a house. And I had to put 3 of them on the loan. To make it happen. And that's the thing, is just you need a loan officer who's going to look at every angle. How can we make this work?
Right.
And that's the thing. There's good and bad loan officers at every company. So I'm not going to sit here and say that there's one mortgage company that's better than the other. It really depends on the loan officer that's behind it.
Okay. All right. So, Phillip, there are a lot of people out here who do not know what a brokered loan is.
Okay.
So can you kind of break that down? And Robert, can you put 2 minutes on the clock, because we need the fast version of this, because this could go for a while. But just 2 minutes, kind of give us the simplified version of what a brokered loan is.
So what I'm going to do is I'm going to give you a quick comparison. So again, I'm going to tell you what a retail loan officer is first. Just kind of you can
tell us my job.
Well, yeah, because I'm going to ask him his. I'm going to ask him his next.
Well, so again, the retail lender, just part of it is they close it, underwrite it in their name, they keep it, and even after closing, it stays with them, right? Then you have a correspondent lender. This loan officer works for a mortgage company, because I don't want to say any lenders here, and then they still close it, underwrite in their name, and then they sell it after closing. And now you've got the question your client asks.
Sell it to another bank for long term.
Sell it to another mortgage company,
investment,
right? Now, as a broker, what I do is I send it to this company that I'm going to be technically selling it to afterwards. We don't sell it because they are keeping it. So I do the loan, they underwrite it, they close it in their name. And even after closing, that mortgage stays with them. So again, I'm going to be your point of contact the whole way through this transaction. And again, as a broker, just to clear up some myths, I do have direct access to my underwriting. And I do have cheaper fees. Again, we don't have an underwriting fee. I do have a processing fee. My processing fee is much lower than most mortgage companies. So I'm not going to say it's the lowest, but I'm going to say, yeah, we don't have an underwriting fee, and my processing fee is only $6.95. You're not going to beat that as a fee sheet. It's just no way.
Okay. We're going to get into fees here in a little bit, but is there anything else to the broker loan side?
And again, access to 250 lenders.
Okay.
We can do any type of loan you want. Literally, we are a one-stop shop. And that's one thing I liked about when I was at this company compared to other companies. When I brokered a loan at the other company, I could only broker a loan if it didn't meet their in-house guidelines, but the interest rates were higher. So why would I do it? So, but again, interest rate's not everything. I mean, again, like I'll say, you don't see commercials for Bentley. You don't see commercials for Lamborghini. Why is that? Because people know the value. So, I mean, again, it all depends on the loan officer that they're bringing to the table. Yes, I could work at any mortgage company, and I'm still going to be successful because of what I bring to the table. The client, the realtors know that deal is going to close. So that's what I would say is what's more important. Who are you working with? Who are you dealing with?
Okay. So now, Jeremy, Jeremy, give us a 2 minute. Are you keeping track? All right, 2 minutes. Give us the short and sweet breakdown on what it is to be a retail or a correspondence lender.
Well, don't know what it is to be a correspondent because we're not correspondent, but I know what a correspondent is. And
Okay.
unlike my counterpart here, I will use examples. OVM is a great example of a correspondent lender where their name is going to be on the application. They're going to underwrite it. They're going to process it, but then they're going to sell it off to BB&T, Truist, SunTrust afterwards, right? They don't service anything, right? And then, Movement, we're one of the top 10 purchase lenders in the U.S., number 6, number 6 in VA, number 1 in USDA, all that stuff. What we do is everything's done in-house. I take your application, I process it, I underwrite it, we close it, we service it, all in-house. You're going to see a mortgage statement every single month with my big-ass head on it, and we refi it. Now, what don't ask for someone to put to that is in a time like this, just like UWM, where he would send a loan to UWM and I would do a loan at Movement, there's going to be times, because there's 2 parts to a loan, the note itself and the MSR, which is the mortgage servicing rights. You ever get that letter in the mail that says, hey, now make your payments to this such and such bank on the 1st of the month, whatever? Because you sign on that closing disclosure and your initial closing disclosure that they have every right to sell your loan off to another mortgage to somebody else, right? And that's a liquidity, grab, right? So which usually goes to UW and will sell to a Chase or to a Regions or to whatever, right? Because that bank doesn't care about having interest rates at 2-3%, because they're trying to sell them different products, right? And they want that note to be made for the next 30 years. We're an independent mortgage bank or a wholesaler. If they do retain it on their books, they want the higher rates or the higher government because that has a greater return, on it. But not getting too deep into capital markets.
So you said something there that was kind of key. So, just an example, you said Chase. So Chase will buy the lower loans, the lower interest rate loans, but that's because they want to sell them some other bank product, credit cards,
checking accounts, savings accounts, and then they want to strengthen their relationship with that client.
That makes sense, though. I mean, I think that's good marketing, good networking. So that would make sense from a business perspective.
Yeah, I mean, if I'm selling a pool of C30s at whatever, and I sell them to Chase for 75 basis points, on the dollar, then my bank gets money. We get liquidity influence. Our balance sheets looks much better. Chase gets 100,000 clients that they can now cross sell opportunities to.
All right, so now we're gonna get into. We broke down what each type of loan is, but
we ran out of time.
Oh, we ran out of time, Jeremy. You got to stay on target.
Well, but. I did give Phil a little bit more time.
You did.
So we can give him a little bit more time.
What's the question?
But no, so the next question, I'm going to go to Phillip first because you just spoke. I'll let you get a second to catch your breath.
You good.
And then I'm going to come back to you. So the next question that everybody has is about the fees, right? And so everybody wants to know, how do I figure out what my closing costs are, what I'm going to need to bring to the table? And so the question is, can you detail all the fees associated with your loan options, including any hidden charges, and explain how your compensation structure might influence the loan options you present to your client?
Sure. Yeah. So one of the things about brokers, the max compensation any mortgage broker company can make is 275 basis points or 2.75%. Okay.
Okay.
So that's max.
Okay. Is that 2.75% of the loan?
Of the loan amount.
Okay.
That our company makes as profit on that loan.
Okay.
That maximum. So some retail lenders, but not all, are up to 400, 500 basis points. So 4 to 5%, which is why some of their interest rates are higher than brokers because they're making more margin. Not all lenders are like that, but some do have higher margins that they make on some of their loans. Now the conventionals, they'll make maybe 200, 300, or again 2 to 3%. But again, so that's why you're going to notice that brokers, for the most part, do have lower interest rates because we have less margins built into our loans.
Okay.
And that's why we're called wholesalers. We have access to wholesale interest rates, and we pass that benefit on to our clients.
Okay.
Second thing is no underwriting fees. I don't have an underwriter. The company I send that loan to, they have an underwriter. Now, every broker has an option whether they want to charge an underwriting fee or not. I don't. That's my preference. But every broker can set up differently. Every broker can be lower than 275 basis points. They can say, hey, my whole company is going to run off 150, and they're hoping that they're going to make more in volume, that they're going to close 1,000 transactions versus this other company does only 500. So it's up to the broker on what they want to do. But again, they have that flexibility. They have that option. So again,
Was that 2 minutes?
That's 2 minutes.
Oh man, we gotta hear more though, because all we heard was about was the compensation.
Well, we'll keep it going then.
And we'll give you 2 more minutes, and we'll come back. We'll give you 4. Okay. Well, let's make it 3, and we'll go 5 total. Okay.
Okay.
So we heard the compensation, but break down the fees, because I think that's the most important thing for our viewers. Any fees or what they call hidden charges.
Again, nothing's going to be hidden. Everything's going to be on the loan estimate. So I'm not sure where this is coming from, but
it's because people don't know, so they just assume that there's something else going on. But go ahead.
But if you compare a traditional lender and a broker, again, for the most part, not all the time, broker fees are going to be lower. Again, we don't have underwriters, we don't have processors, we don't have branch managers, we don't have area managers. We don't need to do that. So that's where we're able to operate on a skinnier margin than most lenders can.
All right. So what fees do you charge?
Me personally, the only thing you're going to see on my loan estimate is a $695 underwriting fee. Now, again, we'll charge a discount fee potentially depending on your credit score or the type of loan that we're doing.
What's a discount fee? Does the consumer get a discount with that?
No. So that's a cost to get that interest rate due to the type of loan that you're doing. So it's a cost to get that interest rate.
So they got to put more money down.
Potentially, yes. So again, like anybody, if you do an investment transaction, you're probably gonna have to do some discount points to get that interest rate because again, the federal government, Fannie Mae, Ginnie Mae, all of them aren't buying. That's not in their appetite right now. So we have to charge to give them that rate. So again, it just depends on the program we're doing. But yes, some of our fees look like we're charging a lot more because again, these are riskier loans. Like I can go down to 500 credit score on an FHA loan. That's gonna have some discount points. So it doesn't. We're not hiding anything. We're not charging more than anybody else. We're the only company that's going to do those type of loans.
Okay. What about appraisal fees, credit reports, anything like that? Do you charge those fees?
Yep. And the appraisals is going to be standard. The appraisal is not going to change from lender to lender. Again, appraisal management companies, but again, VA appraisals is going to be the same across the board, $600. We can't charge more than that. That's what the VA mandates that we charge. Credit reports is going to be the same. Again, we're for individual bar, 33, for joint, $77. So, I mean, that's standard. It's nothing extra that we're charging on the broker side. Again, if you want to look at some of the hard money stuff that we can do, commercial stuff, yeah, there are going to be some extra fees on there. But again, we're doing loans that nobody else is going to do. Like, you come to us when your banks and commercial lenders say no on the specialty loans. But yeah, those are going to have fees because there's no margin to be made on those loans when we do those loans. We have to charge origination on those type of loans.
Okay. All right. Same question, 5 minutes. Let me just refresh it real quick so that way you know, all right? So can you detail all the fees associated with your loan options, including hidden charges, and explain how your compensation structure might influence the loan options you present to your clients?
My compensation is going to be the exact same whether I quote you X rate or Y rate, right? The government took that out a long time ago where we can't get paid based on compensation, myself and Phil included, okay? In regards to that, it's going to vary from product to product, right? We have a down payment assistance program, VHDA. That's the state. The VHDA, you need down payment assistance through the Virginia Department of Housing, 500 processing, 500 underwriting fee, right? We used to be the only lender in the area that didn't charge any fees on our VA loan products at all whatsoever, processing, underwriting, anything. I think now we do have one for the VA, which is $995, but that's it. And that is the only fee you will see on our VA loan products at all whatsoever. Okay. And then as far as conventional and FHA, you're going to see just the one-time fees that we have on that, standard processing fees on that, $1,100 or whatever it is, $1,200. So, and that is combined with whether you want to call it underwriting and processing or whatever, but it's just, that's going to be at that total. The only thing, and again, because it's not every broker, because I'm not going to speak for Phil here, being a former broker, you have a third-party processing fee. We have a processing fee, right? So there's going to be processing fees, right? And with the underwriting fees, brokers have the discretion of doing what's called fees in, fees out. So when they price your interest rate, right, they're going to take that underwriting fee and price it into the loan. So the term hidden can be used or not used if they take, if Phil is just saying, yeah, I mean, because here's the thing. He doesn't have underwriters as a broker. But guess who does have underwriters? The bank that he sends it to has underwriters. You think those underwriters work for free? You think Matt Ishbia is just paying his people with flowers and roses at the end of the month? No, that ain't what he's doing, okay? Yeah. There's the damn sure hell is an underwriting fee. What brokers have the opportunity to do and say, okay, we're going to take this fee And it's typically a dollar for dollar adjustment, and you're going to see that in your interest rate. So if you go to Phil one day, or not, something I don't say his name, but any broker one day, and you're competing, and you see an underwriting fee, you know, that's not in there, but they have a higher rate, but then all of a sudden they need to get lower, you're going to see a lower rate, but then you're going to see an underwriting fee magically appear on your loan estimate. You see what I'm saying? So it depends on how it's getting disclosed, because brokers have the option to do fees in, fees out. So there's an underwriting fee. It's just whether they're saying, yeah, I'm going to out for, and Phil, correct me if I'm wrong.
No, you're right. But again, the interest rate's still better, though, on the broker side, even with buying.
And that's where we can get into competitiveness and value, right? And that's where we need to talk about what you're getting and what the client ultimately needs, right? Because if we're nickel and diming over an eighth and a quarter,
don't go into that, because that's going to be a further question.
But there you go. Those are my fees and my compensation set, regardless of whatever he has. So yeah, brokers can charge max of 275 basis points. Conventionals right now, usually across the board, but I can only speak for a movement right now. We don't have much baked in, 2 7/8, right? So there's not much. We are very thin and we're very competitive, and we actually have a loan level pricing adjustment on loans under 300,000. So I actually beat a broker the other day on a primary resident by half a point because we service our own loans, and because we took into account for the 300 LLPA for loans under 300,000, I was better by half a point, just straight up.
And broker must have been hungry because you want to beat me.
Yeah.
I did not be funny.
No, I'm just kidding. But again, every broker, and that's where I'm saying, man, like it's tomato. You know what I'm saying?
Yeah.
Like you can go to one restaurant, the food's banging, go to the same restaurant the next day and it's trash. So.
Okay, I got you. All right, so here goes the next one, right? So what unique advantage does your approach offer? We're going to start with Jeremy on this one. What unique advantage does your approach offer to potential home buyers?
My unique approach, especially when it comes to loan rescue, is here's the thing. I love when we talk about not having direct access to underwriters. Within a capacity, brokers do, and I'm going to let Phil talk about that. For me, I don't have to go through an account executive, to go through the first underwriter, to go through the senior underwriter, to get to the underwriting manager, to get to the VP, to then get this on Matt Ishbia's desk, or get this to whoever the owner of Rocket is, right? Because you have to understand, there has to be, what type of paper you're doing, right? A paper meaning 700 plus FICO scores, and then there's the below 620, right? Below 640, right? Because Matt Ishbia don't play in that 640 and below sandbox, right? He prices you out to say, take that shit somewhere else to freedom. Well, they'll do it, okay? For me, it's, my VP is on my, I play Call of Duty with this motherfucker at night. You know what I'm saying? Like, I'll talk to him about something and like, hey, my boy Josh hit me up on this deal. Can we do it? This is what we got, because they get denied it over there at OVM. Legit play Call of Duty. And he'll tell me yes or no right then and there. He sends me an email. I drop it in the file. When he goes into underwriting's desk, we have 671. So we have 6-hour underwrite, 7-day processing, 1-day close. We closed over 30 billion in mortgages last year. Over 70% of those were done and ready to go in 10 business days. Okay. So I don't need to beg and plead for an exception. If it's a hot minute closing, UWN does have you close 2.0, so he can balance out his own closing package, all stuff like that. But you're still going to be in a queue 20, 30 minutes, or he's going to have to go to his AE and wait. And don't get me wrong, UWM is number one for a reason. They are fast. But UWM is an outlier for those easy 20% down, low ratio loans, right? You want like a hard something done, they're looking at Carrington, they're looking at Freedom, Freedom, when you're trying to do a regular refinance, literally 60 to 90 days. They'll say, hey, we're going to give you a bottom of the barrel rate, but you ain't closing for however long, right? Then Caliber and New Res and all stuff like that. So I know my guidelines are much more lenient than theirs, So if we take UWM and we encapsulate it into one bucket, really, like it's all about what you want to do. Like buying a house is a privilege. It's not a right. You should not be buying a home with a 500 FICO score. You shouldn't be buying a house with a 550 or 570. I don't care if FHA says, yeah, you can put 10% down. It doesn't matter, right? Like, there's very, very few people who should buy it at that FICO score, right? So, yeah, because you read a VA circular, the VA says right there is no minimum credit score requirement for a VA loan. Most loan officers don't know that. They just spit out whatever. I tell all my clients, no. The VA circular says, no, there's not. It says it's decided up to what level of risk the bank is willing to take. Most good ones will go to 580. I will go to 580. Manual underwrite. If we're not getting automated approval, I know I'm the manual underwrite king at my company, especially in my market. But if I need to do something or get an exception, or I'm not wasting Josh's time because Josh needs to know right now, hey, this mother trucker denied this loan. Can you do it? Let me get the app. Let me get the credit report. Let me see it. Yo, bro, can I do this loan right now? Yes or no? I need to know. And they're going to tell me usually within 6 hours, if not 30 minutes. Like when I did, again, I don't, your partner that we just had Cobalt with the other day. Yeah. Okay. Got that knocked out in 7 days. Yeah. 7 days. Okay. Like, something that they had for months that was just did not, and I didn't want to waste anybody's time because you want to take all the guesswork out. So my biggest thing is when you come to me, you're going to get certainty from day one, right? So if I write a pre-approval letter, knock on wood, last thing on my news, I haven't written a pre-approval letter that hasn't closed. You know what I mean? Like it's going to close. If I write it for you, it's going to close. And if I need that exception or I don't need to go back into a queue with any other wholesaler, it's a queue. We have to wait for this underwriting queue. We have to wait for this underwriting queue. Like, if I get an HOI policy or COE or any document has to get reviewed, it has to get into a queue. You might be able to ask for an exception and 1 out of 20 might get approved. I don't need to wait if I get something updated or whatever like that. My stuff, when I say my ops is here local, I used to process and underwrite with these guys. I throw peanuts and popcorn at them. Like I can go knock on their desk, right? Like I give them pizza and cupcakes for a reason. Me personally, because I know it is me, humbly speaking, if me and my counterpart that you named at the beginning of the show, Ben or whoever, I know if it's 4 o'clock and they got one more loan to underwrite at the end of the day, they're going to do mine first before his because they know me more, they know me better, they know me longer, and I treat them right. You know what I mean? Yeah. And he's a good loan officer. You know what I mean? But I'm just saying, me personally, it's the relationships. Going to another company would set me back 4 years because I know who's who, what's what, and I know what I can get done and I know what I can't. You know what I mean? I don't have to sit there and beg or wait in a queue or have an exception. Like, Matt Ishbia might be a good. How many times have you spoken with Matt Ishbia personally?
Twice.
Okay. Out of that twice, has he ever overridden or given you an exception for anything on a loan product?
Once.
But
only once I needed to ask.
Only one is it. You know what I'm saying? Like,
so he's 1 for 1.
No, cool. You know what I'm saying? My thing is I don't need to go to my owner much, but my owner's in the same office with me, and I have lunch with him, and I have a stogie. Yeah. And I have a beer.
So yeah. I know we got off track, but I want to just recap it. So if I understand you correctly, is it a fair statement to say in everything that
plus
you
I can broker too. I have over 1,000 products. I can say that. But I can retail and I can broker.
Okay. But is it fair to say that why your product is advantageous is because service and speed?
It's like Amazon. Great pricing, great service, great rates. You're going to love it.
All right. So
very closer to the mic.
Sorry. Great service, great speed, great pricing. It's like Amazon. That's why people love Amazon so much.
Yeah. All right. So look, Phillip, that's a lot. Make sure you get the clock right.
And I got to make that plug. Hold on, make that note. And I can broker too. I'm retail plus I can broker.
Okay. I got you. All right. So now we're going to come over to Phillip. Same question. What unique advantage does your approach offer to potential home buyers?
Okay. So my buddy here just said that it had more lenient guidelines. Well, the thing is, depending on what you're talking about, again, we have access to 250 lenders. We're adding to that list every day. We just added another lender. And again, I'm not using Freedom anymore. Again,
how many do you use on a daily basis?
Oh, hold on.
No. So I'm glad you asked that. I actually have Loan Sifter, which is the optimal blue version on the broker side. I price it out every day on every client. Believe me, I would love to send all my deals with UWM if I could. Mm-hmm. Don't get me wrong, because I'm going to give it. Movement does have operational excellence. I will not take that away from them. They are awesome. They are fast. But UWM on the side, for the amount that they're closing, they're super fast if I can get it to them. But again, I do have other options. There's not a loan I have to refer to another loan officer. There's not. If I can't get it done, it's not getting done with me. There are brokers who don't know what they're doing. I'm sorry, but that's going to be at any company. You send a loan to me, if it can't get done, it can't get done. There's nothing else can be done. I have lenders that literally the lowest guidelines. I can do a VA manual underwrite up to 65% debt to income. Every other lender out there, no. VA's guideline says 50%. No, again, that's not VA's guideline. True, yeah. They have no maximum. It's what the lender is willing to take on. I've got 3 different lenders that I know each of them can do 65% debt to income manual underwrite. That's who I'm going to. Yes, it is going to be in queue because, again, that's a risky loan. You're going to want to make sure you have a lender that's making sure they're looking over that and getting it done. But at least I can tell you how many times I get loans all the time from other mortgage companies. Hey, I'm at a 50 debt to income. I can't do it. Can you do it? But yeah, hell yeah, send it over. I will do those all day long. So again, I can officially say I have the most lenient guidelines because again, I have 250 lenders who let me do almost any type of loan that I need to get done. I can get it done. So again, whether it's commercial, and again, not to toot my horn on this, but again, we have no income doc loans for primary residence back on our side. Again, there are certain loans, like I've got a deal right now from another lender that I used to work at. They broker too, but guess what? They're not allowed to do every brokered loan that company offers. Literally, this loan is fully approved at this lender that they're brokering to. They can't get it done because their company doesn't want them to do that type of loan. They sent that loan to me. I'm not gonna lie, it's a $300,000 loan. It is Christmas and March right now for me. Again, I resent it back to the same lender that they were brokering it to and getting it closed. Again, so there's differences. Even though you have the ability to broker, your company can say, no, I'm not gonna let you do every broker product that's out there available. And which is one of the reasons I left my previous company. The reason I left there twice, I was at this company twice. The first time they hit margin compression. So I'm like, I understand that. So I left there. And then they started sending me business that they couldn't get done because I was at another company that allowed me to do both. I could do retail and broker. So then they says, hey, why don't you come back over and run our broker division? So I came back over to them, opened up their broker division, had them going doing stuff. But again, the same thing. They didn't want to do certain type of loans. I'm like, what's the point of even bringing me back if you're not going to let us do everything? I could help your loan officers pretty much close anything that they want to do. Anyway, so I left.
But what are those certain type of loans? Because I got to ask that question. Like, why would a lender not want to close a loan?
Well, because certain Wells Fargo, they're very adverse to risk. They don't want to do anything below 580. They do. I mean, they have guidelines. When I work there, they do loans down to 500 FHA and VA. But again, it depends on the lender. So again, if the lender doesn't want to do anything below 580, then they don't have to.
Yeah, but if you're brokering it to somebody else, why would it make a difference if it's already underwritten and you got a clear to close on? Why wouldn't you let that go?
Again, certain lenders don't want to do certain type of loans.
Is it because they're afraid that it's going to give them some negative connotation? Because like, when I just, this happened here, so I want to tell you, like, he said you have like subprime. Are we talking subprime? Is that what this is?
No, this loan is not. It is a subprime type of loan. Yes, it is not traditional.
Or non-QM if you want to use that.
Yes, non-QM.
Non-qualified mortgage.
Yeah, and that's pretty much what we're now considering subprime is the non-QM loans. But again, not necessarily all non-QM loans are subprime. I've got non-QM loans that, these clients are in the 700 credit score range. But again, we're doing a no-income doc loan because either they went through a divorce or their business just went, there's a number of different reasons why. But again, they have a 700 credit score. They've got the money to put 20% down. So we've got the options to do stuff that other lenders just don't want to do because they are riskier. But again, you just got to put things in place to make sure that the client understands what they're getting into.
I'm a little bit baffled by that because, like, if you're brokering a loan to somebody else, why would you care where it ends up and what?
That's why that company's no longer in business.
Okay, I don't know. Maybe that's something I don't know.
If they're insolvent, which company was that?
No, it was the lender that was doing the loan. They brokered it because they says, oh, we have access to retail and brokered loans. They brokered it to a company. When they brokered it, the originating lender said, no, we're not going to let you do that specific type of loan with that broker, with that wholesale lender.
Once again, why they're not in business, why they were bought out.
No, yeah.
Yeah, you know what I'm talking about.
Yeah. But again, they were like that even before I left.
Yeah. Well, they were correspondents, so they were like a true, again, you can't compare apple to apples because they never really tried to get their broker desk up and running. So it was a joke.
It was.
It was a joke.
And that's why I left.
Yeah, that's why everyone's left.
Yeah, you ain't lying.
That's why everyone's left.
You ain't lying.
Trash.
They left all their top producers, everything.
Trash.
All right.
I'm not very PC, as you can see.
No, that's okay.
I'm just trying to make sure I don't get any lawsuits. So that's what I was trying to tell you before we started, but then we got into the show.
I don't give a damn about no lawsuit. I'm not, no defamation. I'm just calling the truth. It's public record. You can't sue me for public record.
And we're all entitled to our opinion.
There you go.
That's it.
So somebody can say, "Oh, this
could be based on your experience or based on your opinion."
Yeah. All right. So now, I'm going to ask both of you a question, but it's going to be about the opposite loan product, okay? Or like the opposite way of doing business, right? So it's going to be a fill in the blank. right? Because you guys are the experts in the mortgage industry, right? So, Phillip, I'm going to start with you, okay? Critics argue the biggest drawback to retail loans is blank.
Depending on the retail lender, is their speed.
Okay.
It takes forever to get loans closed. Not all retail lenders, but there are a good amount of the average clear to close time right now for most lenders is 45 days.
What's a reasonable time to close?
30 days or less. But
2 weeks.
Reasonable.
All right, so look. So his response was the biggest drawback. Critics argue the biggest drawback for retail loans is speed. So, Jeremy, how do you respond to this challenge, and what measures do you take to mitigate these issues?
Just get shit done.
I mean, movement is an exception to retail lenders.
You know what I mean? Like, I don't know another way to get a loan done other than the way we do it with our upfront underwriting. Like, I guess that's my. If I'll wait till you ask me that question so I can.
No, go ahead.
So same question for me, right?
Yeah.
So my thing is I submit a loan. Let's take UWM as the outlier, okay? Because I can submit a loan to UWM and get a conditional approval the same day. My issue with wholesale, depending on the product that you're doing, it's going to sit in setup queue for 3 days. It's going to have to sit on a registration desk for another day. Then it's going to sit on an underwriter's desk for another 2-3 days. And then the conditions are going to come out. And then your third-party processor is going to scrub the loan and get conditions. And then, so I would say speed. I would say, speed would probably be my issue. And then, we get shiny object syndrome as people. We get the, paralysis by analysis, right? Like, one thing I don't really miss about being a broker is, whether I had access to 10 brokers or 250, that's too much fucking thinking. Okay, can't do this here. I'm going to move this here. I got to do this. I got to do this here. I got to do this. I got to do this. Sometimes that is an advantage, but that is a lot of freaking work. And then I got to have 20,000 tabs open to figure out, minus the loan sifter, but then I got to do this, and I got to export my 3.4 file. Then I got to upload this, and I got to upload this. Then I got to call my A. Then I got to call my underwriter. Too many steps. Too many steps. Like, we're talking about product, right? He wants to say 250 different whatever, right? I can do a non-QM in-house. I can do a bank statement. I can do a DSCR. I can do a P&L only. I can do an I-10 loan. I can do whatever. You know what I mean? And I can do those all in-house. If I needed to broker those out, like I have Carrington, I can broker that out. My company's not telling me don't go to 500 FICO score. I just don't advertise 500 FICOs. He won't advertise 500 FICO score. That's dog shit. Like, no one's going to sit here and advertise a 500 FICO score because there's so much work that has to be on top of that. So, respectfully, the same answer I would say would just be speed. You know what I mean? Like know your shit.
Yeah, but so all right, I got your response to his, but how do you handle that? Like,
how do I combat it?
Yeah. Like, what do you as a loan officer?
I work for Movement Mortgage, where we have 6-hour underwriting. So our processors and underwriters are compensated. Their large majority of their compensation is predicated upon, if I submit this at 8 a.m., it better be done by the end of business. They're missed out on their bonuses. Our processors have to get the loan completely processed, pending HOI and title and appraisal, within 7 days, or else they don't get the other half of their paycheck. You know what I'm saying? They just don't. So they're trying to get that loan processed, getting the VOEs in, VORs, verification of before, like they trying to close before we are. Okay,
what's VOE?
Verification of employment. Like they're doing all. And here's another thing: if you're a good loan officer, how I combat that is, what am I dealing with here? Am I dealing with a cop or a teacher who's a salary cookie cutter income? I'm not going to need to worry about their verification of employment because it's going to match, right? Am I dealing with somebody who has variable income? Because people don't know how much they get paid. How much do you get paid? $20 an hour. How often do you work? I mean, I work 40 hours every week. No, you don't. I got a pay stub and it says 39 hours. And every pay stub says 38, 37, 36. No, bro, you are variable. So that means now I got to get depending on the loan product and your prior work history, there might be a situation where I have to get a 24-month average of your income. So now we need to get a verification of employment to get your year-end totals. And since you're variable, I got to break down your base pay, any overtime and bonuses, and average that over 24 months. Or was there a material change? You had $20 an hour 12 months ago, but now you get paid $22 an hour. I can get 12 months worth of pay stubs, add up all the hours, times by the new pay rate, divide by 12. Like, what are we talking about here? Can I make a substantial argument, depending on the loan product, Fannie, Freddie, at VA, about using a higher, different average other than outside of that. But what are you doing? So give me your pay stubs, give me your W-2s, give me your 2 most recent, your 2 most year-end pay stubs, and then I'm going to look at the work number. We have an automated verification of employment system. So I'm doing all the math up front. Loan officer's problem, and this is not a Phil of retail thing, is math. Can you do math? And not LO math. He makes this much. Can you do underwriter guideline math? And do you know your guidelines? Are you in the book? Fannie, Freddie, Freddie. You see what I'm saying? And that's another benefit where my guy, he called Freddie today. He called Fannie for me. Hey, do we have this appetite for this? Because I know we sell directly to you. Can we do it? Yes or no? Yeah, we'll do it for you guys. Okay, cool.
Wow, that's a lot of information. But I'm glad that you went through all that though, because I think some people they don't never know the workload of what a loan officer does and what goes on in the background.
No idea.
So I think you gave them a little peek behind the curtain. All right, Phillip.
Real quick, Josh, we're at 50 minutes.
Okay, we're still rolling. I mean, we're
cool.
going. So
we run out of room on our film though.
Yep. So Phillip, did I ask you the question? Oh, you said, yeah. So, Jeremy, critics argue that the biggest drawback to brokered loans is blank.
Biggest drawback to brokered loans is blank. Probably the common answer you're going to get is fees and underwriting, not having process, not having true direct access to control the process from start to finish.
Okay. All right, so Phillip, your question is essentially, how do you respond to this challenge, and what measures do you take to mitigate these issues?
Again, same thing. I'm very impressed with Jeremy, I'm not gonna lie. I make sure I do upfront underwriting myself as well. I know guidelines better than most underwriters myself. I've got that compliment from many loan officers, branch managers that, hey, wow, you do a really great job. And that's making sure, don't do a half bullshit job up front. Get everything. Like one of the things most of my loan officers do not ask for, their year-end pay stubs. Get that 2023 and 2022 year-end pay stubs, and that way you can calculate right now. So that's the thing, is just as a loan officer, know what you're doing. And again, like you said, it's not a retail or wholesale. It is the loan officer getting everything up front. I drew that line in the sand a long time ago. I'm no longer going to issue pre-approvals without getting all their documents. And that way, I know, the realtor knows, and the borrower knows 100% this loan is getting done. It's not, I took the client at their word, because again, there's a saying, unfortunately, buyers are liars and sellers are too. And again, it's not that they're liars, it's just they're inaccurate. Again, they assume that there are 40 hours. Get everything up front, get it done. But again, not having access to underwriters, yes, I can't knock on their door. But they answer their phone just as quick for me. Again, I don't sit in a queue with UWM, but there are other lenders. Again, they're at 24 hours. That's still fast enough for me that their turn times are 24 hours. Again, I'm not gonna lie, it is awesome to know by the end of the day for a realtor client, by the end of the day, to know that you're approved with any type of loan product. Yeah, that is huge as a weight lifted off for your clients. But again, if it's gonna be a riskier loan, you're gonna have to understand, yeah, this is gonna take a little bit longer to review.
Well, even with the riskier ones, like not having, some of your wholesalers do, so I'll give you credit for that. A true, what we call a TBD underwrite, right? So you got this guy, hey man, he has a really low credit score. He's scared of his stack. Can you take a look at it, right? Most lenders will have a scenario desk, right? Like wholesale. I think we can do it, right? But they won't have a true upfront underwrite where if I have a contract from you and it's going into underwriting queue and it's done in 6 hours, guess what? A guy who doesn't have a contract, who's really worried about their credit and their income, as long as I gather all the income documentation, I have that, and I put that on my underwriter's desk, it's still getting reviewed within 6 hours. So I'm not giving you a pre-qualification letter. I'm giving you a pre-approval letter. And those are two different things, because my pre-approval letter came from underwriting, and underwriters reviewed your income, your credit, and your assets and said, yo, you're good to go. So that's why I can offer 1 to 2 week closings.
Yeah, well, and the thing is, just I don't know how long it's been since you've been on the broker side, but we now do have options now to,
that's why I said some people
to do full TBD. But
some
again,
do. Yep.
Not all brokers have access to it.
Correct.
All right, so look, we're next one is we just went to Phillip. We'll go to Jeremy. How do you ensure your clients are getting the most competitive interest rate and favorable loan terms available to them based on their financial situation? And what steps do you take to lock in those rates?
Couple of things. We have secure and sell, secure and buy. So if, we need to lock in a rate before they have a property, we can do that. Every client's going to be different, right? It's not a one size fits all. I tell clients that interest rates change every single day, just like a gallon of gas and just like a gallon of milk. Okay. You go to get a gallon of gas on Monday, it could be $3.40. You see it on Wednesday, it's $2.50. You're like, shit, I want to get the difference back. You can't do that. You locked in Monday. Like, that's just what it is. I explain it like a coloring book with the crayons. If me and you're going to get a flight to Jamaica and I fly coach, but you fly first class, guess what? We're both going to Jamaica, but you paid extra money to sit first class. So I'm going to present 3 different options. This is what a rate is, no cost. This is what a rate buy down would be at X cost. And if you really want to get aggressive, you can pay extra money. And we have a cost benefit analysis, right? You're going to recoup your money, $2,000, $3,000, whatever the cost buy down is of that rate. My general rule of thumb is if I can help you recoup that within 36 months, it might make sense. We're right now in a refinance market. Doesn't make sense probably to buy your interest rate down. People are like, oh, I do want to buy it down an extra point. Well, if I'm only going to save $37, does $3,000 work out to $37 per month? No, that math doesn't work out. The rules of math and the rules of money don't always align. I keep going back to that. So it's about breaking down the math in black and white and explaining to them this is what it is, right? And this is the value. This isn't Walmart. This isn't everyday low prices either. So if I come out of the gate, I'm like, look, because I'm not here to play games. This is my rate. This is what it is. If me and Phil are going head to head on the same product, same that, and it's a lock loan estimate, and he truly has the best deal, yo, salute, go get that deal. Don't let the door hit you with the good Lord split you, bro. Like, that's what you need to do. But I'm going to educate you. I'm going to give you 3 different loan estimates, and I'm going to show you, because again, what are we talking about? Enlighten, conventional, Govy, Fannie, Freddie? Like, what is it? What's your FICO score like? You got, below 700 FICO score on a, trying to do a conventional, it's going to be a really nasty rate, right? One thing that I don't like about wholesalers is they're going to price out what they don't want. I'm going to have a consistent rate sheet, right? UWM doesn't want the dog shit below 640. They're going to make sure you send that somewhere else. They get too busy and their volume is getting way too busy. They're going to increase their interest rate so they slow down the submission so their underwriters can catch up. I don't have that problem. So what I'm going to do is yes, I'm going to say, what product do we have? What's your FICO score? How much do you want to put down? Because everything goes into it. If you ever meet a loan officer and you ask them that question, hey, what's your today's rate? And they spit out a rate, run.
Whoa. I've had this happen when we were having that, the pandemic thing. We're like, no more VA loans below 640 now. Is that why? Is like just got too many loans,
so,
and then
during the pandemic there was uncertainty. Okay, and this is where we get back into capital markets, and I'm not trying to get down that road, but we had a liquidity crisis. Okay, we had a liquidity crisis where we couldn't fund enough loans, and then it became risky because we didn't know where the mark was going to be because the 10-year Treasury, the interest rates followed the 10-year Treasury. There was no stake in the ground, okay, to say, this is what it was, and no one was going to buy these loans, especially if you were OVM or another correspondent lender who, didn't service your own loans. That started the pandemic was where we serviced our own loans. So if you were being told by an investor, hey, we don't know if these people are going to be employed or not anymore to make the mortgage payments, I want a paper. So they got to be above a 640. But if I service my own loans, guess what? I don't give a shit. That's why we'll still go down to 580. You know what I mean? Like, so it's a whole... And that's where a loan officer has to be like, okay, where do I want to go work at? And that's where a client has to be like, who am I really dealing with? The clients are getting smarter. They're getting, I do need to shop this around. You know what I mean? Yeah. But that would be a reason why right there to say I can't get, Town Bank out once upon a time during the pandemic, they wouldn't do nothing below a 680. Like a paper. Like most Americans don't have that. The average credit score around here is a 630. Are you serious? The average median income just went up to 60 in Hampton Roads. 2 years ago was 45 grand. Like we are a heavy Govy market. So you have to have, good government rates here. The most of the conventionals that we do here, second home or investment anyway. There's a few outliers with the conventional with the more fluent, client segment base and stuff like that. For the most part, if you don't have good FHA, Govy, rates here or VA rates, then you're probably going to get, shot in the foot. But it's about education and breaking down the math. Because here's the thing. That 580 client credit score that he got done with that single mother who has 100% financing, hey, one hand, bravo. But does she understand the true cost of money? Even with my clients at 580, do you understand how much this is actually costing you? Granted, no one's really going to amortize this over 30 full years. But let's say you're in the house for 7 or 30. Like, you have to be educating them on something to refinancing that. Because if you do have the money down, let me show you why 5% at a lower rate, if you have the money to put down, it's going to be better than getting this free money. right? Because people don't understand the cost of money. But most people now are one of two things. I need the least out of pocket, or they're going to be very payment conscious. If you're very payment conscious, a down payment assistance program probably isn't for you. Okay, because you're going to pay more for that. Okay, there's no such thing with free money when you're dealing with the government. I don't care if it's VHDA, Chinoa, or anything else. Okay, there's just no such thing as free money. So you're going to get a higher interest rate for 100% financing. It just is what it is, and it's going to be nasty. Okay, so we got to call a spade a spade. So if you're not smart enough to educate your client on, they're like, okay, so what if I do this or that or whatever the third? Because here's the thing, prepayment doesn't really do me any good. You could probably gain a few years. You have to understand the power of amortization. The power of amortization is greater than the power of prepayment. And that's a whole other one, but I digress.
All right.
All right. Now I gotta let Phil get a chance to respond to this. So how do you ensure your clients are getting the most competitive interest rate and favorable loan terms available to them based on their financial situation? And what steps do you take to lock in those rates?
So again, to what Jeremy is saying, that sometimes lenders will throw out their price sheet. Again, we have access to over 250 lenders, all trying to compete for our business. Because we are a true broker, we only broker. Again, at a previous company, we only brokered 1% of our production. So they knew, they didn't really care. Those account reps, they didn't call us back because we're only 1%. As a true broker, they want my business. They know they can get my FHAV and conventional business. So again, every loan I put through Loan Sifter, and it shows me every lender that will do that product. And then from there, I'll give the client the options, and I'll let them know, yeah, this is the lender I would like to send you to, because again, it's going to be a smooth ride. We can make this nice and easy, get you to the finish line ahead of time. My average clear to close with that lender, United Wholesale, last year, for the whole year, I was under 10 days clear to close with them for the whole year of every loan that I sent them. That's awesome. So again, I say, we can send it to this lender. It's going to smooth, easy ride. Or here's my lender that gives you the best interest rate. It is going to be a little bit longer return time. So just educating your client that, yes, it is going to take a little bit longer. And as long as they understand the pros and cons of the lender that I'm going to be sending them to, then it's a good game. As long as we're getting them closed within the contract date. And again, I can lock my loan immediately with that lender. It's not like I have to send a request and then it gets locked. No. Pretty much most of my lenders, I go into their system, I import their loan, I'll lock it immediately. So, and again, a lot of my lenders, I can lock it till like 3 a.m. the next morning on the previous day's pricing. So again, it's just having the options. And again, we have lenders running pricing specials all the time. Like, hey, if you send me your business, we'll give you extra 50 basis points off. That's how much they want our business. So again, we get pricing specials all the time. And if one lender decides that they're getting too backed up and they do increase their interest rates, which they will do, we'll just go to the next lender who's not backed up and who's giving just as good or even better interest rate because they know this other lender is now just increase their rates. So again, there's never a situation where I'm like, oh crap, the interest rate went up across the board. Now I've got 250 lenders to pick from. We're going to get you the best interest rate.
Okay.
Have you sent the loan to all 250?
No.
Okay.
But I'll tell you, I'm an experienced loan officer.
For sure. You probably have like a top 8.
12.
Okay.
Only because I do hard money loans as well, and so I do those as well. But the thing is like I'm probably one of the few loan officers who use more lenders than most loan officers. I consider myself a student still of the mortgage process. I love to learn as much as I can about every product. Literally, I've closed every type of loan you can think of. I've done a 2-time construction and perm close. I've done a 1-time. I've done reverse. I've done conventional. I've done the. I was one of the first loan officers at Wells Fargo to close a FHA short sale and help the client buy another FHA loan day one. As soon as that program came out, I still remember this transaction. Nuvio Rivera gave me a call and says, hey, I just went to a Wells Fargo convention. They says that you guys can close FHA loans after an FHA short sale. I'm like, let me look up the guidelines. Looked it up. Bank of America was the short sale lender who says no. The short sale approval letter has to say they're not going to go after the client for any deficiency balance. The first letter that they gave us says, hey, there's a deficiency balance. We could potentially come after you. So Wells Fargo was about to deny this loan. Literally, me and the client, we're in my office. I have some granola bars and everything. We are Googling everybody at Bank of America for anybody in upper management's emails. We sent them all of them emails saying, hey, this is a client that's never missed a payment required by the guideline. He's done what he's supposed to do. He waited the full year, because normally most people say if you want to get a short sale approved, you need to go past due first if you want to beat to the headline. He did what he did. He did the short sale process. Took him a full year to get a short sale approved because he never went past due. So we got the letter from Bank of America the next day, resubmitted to underwriting, and got that loan closed. And that's one of the first things that really got my name out in the market. Is I was the first Wells Fargo loan officer to close a back-to-back FHA loans, where the previous one was an FHA loan and short sold.
Anything that closed at Wells Fargo, your name should have been out there.
Yeah, no, you ain't lying. That's one of the reasons why I left. My last loan there, the realtor said that I'd like to accept your client, but just not on your pre-approval letterhead.
So my last question. I'm sorry, I don't want to. So here's the thing. Okay, so you're normal, because we can talk about outliers, commercial, hard money.
Yep.
Your normal everyday client's going to be a residential 1 of 4, right?
Right.
Okay. On how many hands can you count do you use out of those 250? Think about your UW, and you have UWM, right? So did you guys, did Nexus sign that contract that they can't send to Fairway and to Rocket then, correct?
Correct. Yep. Okay,
so omit those two. Those are the two bigger. So out of UWM, probably New Red / Caliber, Freedom, I think Home Point went out of business recently. Who would be your top, let's just say top 5?
I think you set me up, Jeremy, because I'm thinking you're going to try to sign up with those companies afterwards.
I'm not. I'm just 250 options. Brokers are better. You have 5. Fannie, Freddie, like, give me a top 5. Like, give me a top 5.
I'm gonna have to. Unfortunately, I'm just gonna have to not reveal those sources right now. I'm sorry,
man,
buddy.
come on.
Sorry. The magician never reveals all the secrets.
Yeah,
Okay. So
respect.
So I'm gonna propose a scenario to you guys, both of you, and just hear, if you were a buyer, which product would you take? Okay. Purchase price is $365,000. Okay. You're putting $100,000 down.
360, 100 grand down.
365.
100 grand down.
100 grand down. So you're financing $535,000.
You said 365, so now we're financing 265.
I'm sorry. 635.
Okay, 635.
$635,000 is the purchase price.
Okay.
You're putting $100,000 down,
Okay,
so you're financing $535,000.
Okay.
Okay. You have a retail lender offering a 5.75% with no points.
Okay.
You have a mortgage broker offering you 5.625% with a little over 1 point, $5,500
In discount. Okay.
Or you can get a 5.5 and you're paying $8,000 in discount. Which one would you choose, Jerry?
So the retail lender with no points at 5.7. 5.75.
No points.
5.75, no points, or paying a point and getting 5.625 or 5.5.
Josh, 10-minute warning, and we're out of room.
And paying, at 5.5, you're somewhere around like about 1.5.
I mean, there's two ways you could look at that. If someone has 100 grand down, right, they have the cash and liquidity to pay the discount points. That's nothing to them. So that they're going to be that rate conscious, then you might want to go.
No, I didn't ask you about them. I'm asking you, what would you do as a loan officer, knowing the industry? What would you do?
Give me the 5.75, no points.
Okay.
Give me the 5.75, no points.
The retail wins in this one. Mortgage broker. Which loan do you choose for? You're buying your house. Which loan option do you choose?
I'm doing the 5.75 as well.
5.75, no points. So, and I think for a lot of people, they get tied to the interest rates, but they don't think about what the cost of the interest rate is, which when I asked both loan officers who are in the industry, you both chose to go with the 5.75, no points.
Yeah, it's a no-brainer.
All right. I just wanted to share that for our audience, because there are a lot of people out there who are in those scenarios right now, and they're like, do I do it with no points, or do I pay the points and buy the rate down? You could have flipped that
reverse. If he was offering, or wholesaler was offering 5.75 no points, and a retail lender was offering, the lower rate with the point.
Yeah.
Take the no point.
That was a real scenario. That's the reason why I know the numbers.
Yeah, okay. There you
Yeah,
go.
but it depends on the situation. Right now, yeah, we're both going to say 5.75 in this economy
Okay.
because we know rates, what everybody's selling, is that they're going to get better into end of 2024 and 2025. So yeah, do the 5.75. However, depending, again, when rates were in the 2 and 3%, and then when COVID started hitting, we were uncertain. Yeah, you might want to buy the rate down at that point. So it just really depends.
Well, I mean, during COVID, you were getting 2 and 3%. You wouldn't even be at 5%.
And that was
Like
that was
right
an
at-
anomaly
right at the
itself.
end.
Yeah. I mean, that was that was an anomaly. Yeah. I mean, so again, man, the rules of math and the rules of money. Like, break it down. Show me what my payment is. You're talking dollars and cents. Why am I going to pay an extra $5,000 to save an extra $30? I mean, that just doesn't make any. I mean, 500-something thousand. That would have been more like $70, but still.
Yeah. The difference was $84 between the 5.75.
So then you divide the
$80,
$80, the savings and payment, divided by the 5,000. So that probably would have recouped in like 200 some months, like 184 months, whatever it is.
Yeah.
If you divide that, it doesn't make sense. You're with
Exactly.
Again, my math wins.
All right, so last question for both of you, right? So how do you see the retail mortgage evolving in the future with, all of the lawsuits that are going on right now? How do you see the retail sector and mortgages evolving in the future?
In the future, only the strong are going to survive. Only the strong are going to survive. You're going to see the lower ones who are smaller correspondent, who don't have any liquidity, meaning they don't service, they don't own their MSR rights. They're correspondent lenders. The ones who don't have product offerings and consistent closings, they're going to get acquired, or they're going to get bought out, or they're going to go out of business. Okay, that's just truth and point. With your preferred lender, same thing happened with them a couple of months ago when their name changed. Right, we saw that writing on the wall. There's another one around it, so it's going to happen, right? Like we saw, Guild and Academy. You know what I mean? Like it's just going to happen. Personally, with Movement, since we're owned by 51% nonprofit, that's not going to happen to us. Humbly speaking, anything could happen to any lender. Don't get me wrong. The market really goes crazy, but the strong will survive. It's not always about more production. Profit does matter. Okay, I think there's the only constant in our industry is change. So as this thing evolves and as the spectrum of life goes forward, if you're smart, if you're profitable, you have good service, good pricing, good rates, you'll survive. If you got shitty loan officers, you're going to be out of the business.
All right, got to cut you off. Phillip, same question. How do you see your industry in the mortgage brokered industry changing in the future?
As of right now, I mean, again, Nexa, we're the fastest, largest growing broker. We're growing leaps and bounds. I mean, we're having retail loan officers join the broker side all the time. And again, one of the things is, again, the compensation on the broker side for the individual loan officer is better.
False.
We'll agree to disagree, but go ahead.
So you're making 220 basis points over there?
Are you making 220 basis points
Yes, I
after
am.
expenses? After expenses.
All right, let's stay on topic. Go ahead, Phillip. Go ahead.
180 after expenses.
That's not 220.
Yeah.
That's not 220. We'll talk about that later.
Yeah. Go ahead.
But again, like Jeremy said, only the strong brokers are going to survive. Again, we've actually ourselves have taken over other brokerages that joined Nexa because, again, they just don't have the support, the service, and everything like that. Again, being one of the largest brokers, again, when we call a lender that we need something done, it gets done. I personally have sent an email to Matt Ishbia to get my deal done, and it got responded within 24 hours.
Who is this Matt Ishbia guy? You've both mentioned his name several times.
The CEO
He's
of
the
United
CEO.
Wholesale. Yeah, the
Oh,
largest.
UWM?
Yep, UWM.
Okay. All right. That's it.
All right.
Take us out, Robert.
Awesome. Thanks everybody for coming on. Hey, ladies and gentlemen, if you like our video, go ahead and hit that subscribe button. Give us a like. Leave a comment below. I'd like to hear from all the loan officers out there in the world. Let us know your thoughts of the podcast. With that, thanks for watching. See you soon.